Welcome to this explainer. Today, we're diving right into the fascinating mechanics behind the recent turbulence and, honestly, the massive turnaround strategy of the quick service giant Wingstop. Now, if you follow the restaurant industry at all, you already know Wingstop has been this relentless powerhouse. Just an absolute machine. But recently, well, their story hit a pretty major speed bump. And seeing exactly how they are engineering their way out of it is just incredibly revealing. So let's get right into it. We really have to start with this completely shocking number, an 8.7% drop in domestic same-store sales in the first quarter of 2026. I mean, for a brand that has consistently defied gravity for years, a nearly 9% drop, that is a blaring alarm bell, and it definitely sent some serious ripples right through the market. It's a genuine mystery, right? How does a brand with a bulletproof 2-decade winning streak suddenly see its momentum just snap? For 22 years, through recessions, wild market shifts, global events, you name it, Wingstop literally just kept growing. So what on earth actually broke the streak? Well, to understand the fix, we first have to understand the fracture. Section 1, End of an Era. Okay, let's break down the macro headwinds that finally caught up to them. This drop wasn't entirely an internal failure. It was actually heavily driven by some brutal, unplanned winter weather closures across more than 700 restaurants early in the year. And when you're running this high-volume model, losing hundreds of stores for days at a time, that creates a massive, massive mathematical hole right at the start of the quarter. But as you might guess, weather was only part of the story. On top of the weather, we had soaring gas prices fueled by international conflicts, and that severely stressed the balance sheets of Wingstop's diners, directly hitting their foot traffic. We basically saw a repeat of that 2022 fuel spike reaction. The squeeze on people's wallets was so tight that consumers actually completely changed their buying behavior. They started opting for larger, value-driven bundle deals to feed whole groups, which, naturally shifted the overall transaction counts. Now, this is absolutely crucial to understand. A full 25% of Wingstop's customer base consists of lower-income consumers, and this specific cohort is incredibly sensitive to immediate economic pressures, especially at the gas pump. When gas prices spike, their discretionary dining budget basically vanishes, almost instantly. That 25% is a massive chunk of their core audience, all pulling back at the exact same time. Section 2. The Franchise Paradox. Right, so here is where the business mechanics get truly wild. How is it even possible that while individual store sales dropped nearly 9%, the overall system-wide sales actually grew by 5.9%, hitting $1.4 billion? Honestly, it almost looks like a math error. I mean, how on earth do you lose sales at the store level but somehow grow revenue at the system level? And it gets even more baffling. If same-store sales are declining and the core consumer is totally stressed out, why did franchisees just open 97 net new locations globally in a single quarter? That is a 17% unit growth rate, which is well above their long-term algorithm. Brand partners are literally rushing to pour their capital into new concrete. It's crazy. Well, the answer really lies in Wingstop's incredibly lucrative asset-light model and their AUV, or average unit volume. Remember, 98% of Wingstop locations are funded and operated by franchisees. So Wingstop, the corporation, they aren't the ones paying to build these stores or managing the daily labor costs. Nope, they are just collecting royalties on those system-wide sales. And this franchise growth engine is just undeniable. Think about this. An upfront investment of roughly $580,000 yields $2 million in average annual sales per store. That means brand partners make their money back in less than 2 years. Let me tell you, in the restaurant industry, a sub-2-year payback is basically the absolute holy grail. So franchisees are looking right past that short-term dip in same-store sales because, frankly, the underlying economics are just that powerful. Because those unit economics are so insanely strong, Wingstop currently has a record pipeline of over 2,200 restaurant commitments already locked in for development. Franchisees aren't pausing, they are actively accelerating. And this right here is exactly why tracking unit economics matters way more than temporary traffic dips. But Wingstop's leadership obviously knows that to actually sustain this massive growth and reach their new target of $3 million per store, they still have to fix that traffic issue at the ground level. Section 3. The Smart Kitchen Revolution. So, to hit that super ambitious $3 million target, they desperately need a technological overhaul. They are totally ditching those chaotic paper tickets and voice commands, which, by the way, is a pretty drastic change for their tenured employees, and they're deploying what they call the Smart Kitchen.
This is a system that relies on AI-enabled demand forecasting, broken down into tiny 15-minute increments, all to cut service times in half. It's a fundamental operational shift from pure analog chaos straight into digital precision.
And getting that speed right is absolutely critical, especially during those peak Friday and Saturday dinner rushes. Why? Well, because that is the exact window when half of all first-time guests interact with a brand. If a brand new guest walks in on a Saturday night and has to wait 45 minutes for their food, they are simply not coming back. Winning the weekend really is their ultimate acquisition strategy. So they are actively pushing wait times down from an old standard of over 20 minutes, a number that used to spike so high during the Super Bowl that hungry fans would almost miss the halftime show, down to a very strict 10-minute standard. Hitting that 10-minute mark is a total game changer. It transforms them into a highly viable option for, say, a quick Tuesday lunch, and makes for incredibly fast delivery, which opens up entirely new everyday snacking occasions. And you guys, the early data from this rollout is just phenomenal. In just one single quarter, they saw a 16-point improvement in restaurants actually hitting that 10-minute target on weekends. We're talking massive gains in speed, in accuracy, and particularly in the delivery channel, which saw a huge 17-point jump in customer satisfaction. I mean, even the lowest performing bottom quartile stores managed to cut their wait times by 3 minutes. So yeah, the technology is definitively working. Section 4. The future of flavor and loyalty. But listen, operational alchemy just isn't enough on its own, right? You still need people to actually place those orders. So to offset the pressure on their lower income consumers, Wingstop is aggressively, and I mean aggressively, targeting the $50,000 to $100,000 higher income demographic. And the data shows this is currently their fastest growing segment among new guests. They are essentially widening the very top of their funnel to capture a much more economically resilient diner. So, the crucial question is, how do they actually keep these new guests coming back for more? Well, they're rolling out the Club Wingstop loyalty program nationally. And this isn't just some basic, boring points for discount system. It deeply leverages their proprietary first-party data. The pilot results are honestly incredible. Roughly 50% of active guests enrolled, and they captured 40% of all new guests. These loyalty members are showing significantly higher check sizes, and they're bringing lapsed users back at twice the rate of non-members. When you combine that data with their constant flavor innovation, like remember the rapid sellout of the Hot Honey Trio in just 2 weeks, or the massive buzz around Citrus Mojo, it's clear Wingstop is completely modernizing its marketing. They're moving way beyond just standard linear TV sports ads, pivoting instead to highly targeted streaming, OTT advertising, and social media platforms like TikTok, all to capture those everyday snacking occasions. They're even using AI to generate hyper-personalized messages based entirely on your past order history. And all of this brings us directly to their ultimate vision. CEO Michael Skipworth remains incredibly confident that this specific combination of tech and taste is going to power their long-term goals. By fiercely protecting franchisee unit economics, rolling out those AI-powered smart kitchens, and leveraging deep customer loyalty data, they're targeting a $3 million average unit volume per store and a massive 10,000-store global empire. The roadmap is crystal clear, and for sure, the early data is highly promising. But it definitely leaves us with a billion-dollar question, doesn't it? In an era where consumer wallets are tighter than ever, will AI-driven kitchens and personalized loyalty algorithms truly be the exact recipe needed to reboot a broken 22-year growth streak and launch a 10,000-store empire? Well, I guess we're about to find out. Thanks for joining me on this explainer, and I catch you next time.